tremendous amount of enthusiasm in the United States, and there is a great amount of concern over how many of the stocks will look like after the US presidential elections have been concluded. So what is weighing up on the investors' minds in the days and months after one of the most hotly contested elections in United States history? There has been an advice and trade recommendations and numerous mathematical models which have been built around who is expected to win and what and how that can impact stocks in general. They have shifted. The entire discourse has shifted in recent weeks to reflect heightening investor expectations of a blue wave in which Joe Biden beats Donald Trump for the presidency and the Democrats take control of Congress. 4 key areas many Wall Street banks and research houses think will affect the performance of American stocks are taxes, infrastructure spending, regulating big tech, and of course, each candidate's plan for the energy industry, how America becomes self-sufficient. Cutting the corporate tax rate from 35% to 21% was one of Donald Trump's hallmark policy achievements. It provided a boost to American companies' profits and spurred a rise in share buybacks that have in turn helped support the equities market, and we have had a great bull market thereafter. Democratic hopeful Joe Biden wants to increase the corporate tax rate to 28%, still lower than the 35% rate from where Donald Trump took office. Biden has also proposed other changes in US tax policy. So there is a dramatic difference between the way two president nominees are looking at the US economy and the way they are going to run it. Taxes would be the most direct consequence of a democratic sweep for profits of companies listed on America's benchmark S&P 500 index. Wall Street Bank have been estimating many things and using many mathematical models to try and project forward. But the whole thing centers around who is eventually going to come out victorious. If all of Biden's tax proposals were implemented, it would reduce S&P 500 earnings by 9%. That's our calculation. Excluding, of course, any potential second-order impact from economic growth, business confidence and other factors, stocks that would take the heaviest hit would be those that were the biggest winners from Donald Trump's cuts, including AT&T, credit card provider Discover Financial, and hotel operator Hilton Worldwide. Groups with weak credit quality and low effective tax rates could be especially vulnerable, highlighting drugstore chain Walgreens, Boots Alliance, and General Motors. Biden's tax proposals would ultimately morph markedly, I believe, before they are finally implemented, reducing the overall impact on the stock market. If Joe Biden is victorious, then investors expect a large boost to infrastructure spending. As Democrats look to fund their own Hoover Dam-esque projects, it could lift stock prices and help to offset increased corporate taxes that Democrats plan to pursue. A large increase in fiscal spending, funded in part by increased tax revenue, would boost economic growth and help offset the earnings headwind from high tax rates. That would benefit companies in the construction industry, including Caterpillar, Martin Marietta Materials, and Jacobs Engineering. An infrastructure boost would also extend to utilities and railroads such as CSX and Norfolk Southern. Big technology groups including Google, Alphabet, and Facebook have come to dominate the US stock market along with Apple and Microsoft. They account for more than a fifth of S&P 500 today. It is why calls to more closely regulate or even to split some of the groups in two have been followed so closely by investors. Tech companies have already increased their spending on lobbying efforts, political lobbying, so as to say, knowing that sweeping changes could soon arrive regardless of whether a Democratic or a Republican president is in the White House. When companies begin to dominate, then people get afraid of their power, and hence you find the antitrust issues begin to also take center stage. Companies with user-generated content, including Twitter, Facebook, Pinterest, and Snapchat, are also in the crosshairs of Washington's policymakers. The stocks of these companies could be in for a rude awakening if Biden is elected to power. The election comes as energy groups are in the throes of a painful period caused by a consistent and a precipitous fall in oil prices, the coronavirus crisis, and the global transition towards cleaner forms of energy. The S&P 500 Integrated Oil and Gas Index, which includes oil majors Exxon Mobil and Chevron, have tumbled 50% since the start of 2020. A Trump victory next week could of course be a boon for this sector. In addition to supporting energy tax subsidies and rolling back clean air emission standards, Trump has also backed the use of federal lands and waters for drilling. In contrast, Biden has pledged to transition away from the oil industry and has also outlined a plan to spend $2 trillion within the first 4 years in office to cut carbon emissions and electrify the transportation sector, among other initiatives. The stocks of solar and wind energy providers like First Solar and Renewable Energy Group would prosper as a result. Eliminating subsidies to oil and gas companies and a ban on fracking on federal land would deal a further blow to traditional energy groups. This meant that drillers like Occidental and EOG Resources face the biggest risks. This is the scenario in which we are entering into the last phase of elections. And these are some of the companies which would benefit the most and companies which would lose the most. That appears to be at the very face of it. So, contentious election campaign and about to come to an end. But don't forget that Wall Street is awaiting with bated breath the outcome, because it can change the fortunes of these companies which I have outlined in my little presentation. Happy investing. Take care. Bye-bye.